All right, let's dive right into this analysis of Tilray, titled No More Losses. Tilray's $1.5 million net income changes everything. The core idea is that the market is just completely fixated on this reverse split, totally panicking about it.
Yeah, seeing the fear, not the opportunity.
Exactly. And they're ignoring this massive pivot to profitability, that new $1.5 million net income number. It's a classic contrarian buy the dip setup.
A really strong hook.
So let's jump straight in. First, high-level critique. To really maximize the impact of this game-changer data, the analysis needs a deeper analytical foundation for that $1.5 million net income.
Right.
The report does a great job making the case that the old cash burn narrative is dead. It highlights that swing from a $34 million loss to a $1.5 million profit.
And it rightly pairs that with the 42% cut in OPEX, which is, that's a huge operational victory. You have to give them credit for that.
A massive victory.
It is. And the report is smart to say this is real net income, not some adjusted fluff. But here's the thing. The analysis kind of treats this $1.5 million figure as if it's already an established trend, without really digging into the quality of that profit, or more importantly, its sustainability.
So you're saying just showing a profit isn't enough to shock the system? Why is that level of detail needed?
Well, for any kind of sophisticated capital, the source of that profit matters immensely. Think about it. If, say, $1.4 million of that $1.5 million came from selling off a building or some one-time tax benefit.
Something that won't happen next quarter.
Exactly. Then the whole operational victory story sort of loses its punch. It risks oversimplifying how solid this turnaround actually is. We need to get ahead of the skeptic who's going to ask, okay, but where did that money really come from?
Okay, so the goal isn't just to state the profit, but to prove it's structurally sound.
You got it. So the suggestion is to add a brief, but really high-impact section that stress tests this number. That's what moves the argument from, hey, they're profitable now, to they are structurally profitable going forward. That's a much more powerful argument.
So what would that look like in practice? Can you give a concrete example without getting lost in the accounting weeds?
Absolutely. One way is to just explicitly state that the net income did not include any big non-recurring items. No asset sales, no weird tax adjustments.
Okay.
If it was all driven by operations and that amazing 42% OPEX cut, you should be shouting that from the rooftops. That alone is a massive differentiator.
And what about cash flow? Does that play a role here?
Yeah, that's the other angle. You could briefly compare the operational cash flow to the net income. If the company is profitable on paper but still burning cash from its main operations,
the cash burn narrative is deadline gets weaker.
A lot weaker. But showing that operational cash flow is also trending positive, that proves the turnaround is real, supported by both the accounting and the actual cash coming in the door. It makes the management's cost-cutting look foundational, not just temporary.
That makes the whole profitability argument feel, bulletproof. Okay, so assuming we do that, the next huge promise in the report is this idea of institutional capital flooding in.
The institutional wall unlock.
Right. The reverse split gets the share price over $10, the new profit checks the P&L box, and boom, institutions can finally buy in.
The logic is sound. It's laid out very clearly. But I do wonder if we fully considered the time lag. The connection it draws between meeting those criteria and an immediate capital inflow. It needs a bit more nuance.
Why, though? If they've hit the benchmarks their mandates require, why wouldn't they start buying?
Because institutional funds are mandated to look at sustained performance, not just one good quarter. Presenting this as some kind of instantaneous pivot, it risks sounding a little too promotional.
And sets up the reader for disappointment if the stock doesn't pop right away.
Exactly. These funds have compliance checks, due diligence, risk committees, especially in a sector like cannabis that still has, a bit of a cloud over it. They don't just flip a switch.
Okay, so the weakness is setting up an unrealistic timeline. But if you introduce a huge lag, aren't you kind of killing the urgency? The whole point is to buy before the institutions get there.
And that's a great point. But credibility doesn't have to kill urgency. In fact, it can enhance it. So my suggestion is to just acknowledge the process more realistically.
Okay.
Talk about the transitional steps, the friction points. This keeps the bullish outlook but makes the whole prediction much more credible. It's about helping the reader understand when the money will likely arrive, not just that it will.
So what's a realistic time frame that still feels like an opportunity is coming?
I think you have to acknowledge that institutions will probably want to see 2, maybe even 3 quarters of consistent profitability.
Right, to prove it wasn't a fluke.
Exactly. And that waiting period, that 2 to 3 quarter lag, You frame that as the window of opportunity for retail investors to get in before the big money is mandated to follow.
Ah, I like that reframe. The institutional lag is the retail opportunity. What about other risks they'd look at?
Well, you should definitely introduce a specific risk check they'd have to perform, like the ongoing regulatory mess in the US. The report talks about the beer safety net, which is great, but let's be real, institutions will still see US federal uncertainty as a major hurdle.
Sure.
Showing that you've thought about that you know the beer business can't hedge all of that risk, it makes the whole thesis just feel so much smarter.
That definitely adds a layer of sophistication. Okay, so that gives us a much more credible timeline for the institutional money. Now, let's hit the last piece, the valuation gap justification. The analysis needs to forge a stronger link between all these operational improvements and the fair value target it's promising.
Totally agree. So right now, the report points out this huge gap. The stock's trading around an implied 860 post-split.
Against an analyst target of 1780, 100% upside. It's very compelling.
It is. It's simple, it's persuasive, but the weakness is where that 1780 number comes from.
Right. It's just the old $1.78 target multiplied by 10 for the split.
And there's the problem. It feels a bit like, I don't know, hand-me-down math. The whole point of the report is that the 42% OPEX cut and the $1.5 million profit are new, game-changing data points.
So the valuation target should reflect that new reality.
It has to. Otherwise, it feels like a technical trick, not a fundamental justification. You're basically undermining your own best arguments.
I see. So the suggestion is to connect the dots, to explicitly link the cost-cutting mastery and the new profitability directly to that $17.80 price target.
Precisely. Ground that massive upside potential in the new, profitable reality you just spent all this time establishing.
So how do you do that without turning this into a dense financial modeling report that just slows everything down?
You keep it really brief and impactful. Instead of just citing the target, you show a quick calculation. Maybe you show the annualized savings from that 42% OPEX cut.
Ah, okay.
You could say something like, this 42% cut translates to X million dollars in annualized savings, which flows right to the bottom line. That justifies a higher valuation multiple and backs up our 1780 figure. It ties the management story directly to the price.
That links the narrative right to the number. I like that. Is there another way to do it?
Yeah, another creative way would be to change the peer comparison. The report already wants us to see Tilray as a consumer packaged goods company because of the beer diversification, right?
Like Constellation Brands.
Exactly. So prove it. Demonstrate that Tilray's new, lean operational margin structure actually warrants a valuation multiple that's in line with those established CPG companies, not the old money-losing cannabis players. That would be a powerful way to validate that 1780 target.
Okay, so quickly recap the three main points here. We're really focused on building a more sophisticated, institutionally credible argument.
Right. First, we said deepen the profitability analysis. Stress test that $1.5 million to prove it's sustainable and driven by operations, not one-time gimmicks.
Make it bulletproof.
Make it bulletproof. Second, we talked about refining the timeline for the institutional money. Acknowledge the 2 to 3 quarter lag.
And, crucially, frame that lag as the golden window of opportunity for the report's audience.
You got it. And finally, strengthen that 17.80 valuation. Ditch the old math and connect the target directly to the new operational wins, like the OPEX cuts and the improved margins.
The core thesis here is really strong. The idea that the market is just completely missing the fundamental shift because it's scared of the reverse split. That's a fantastic, unique angle.
It's a great angle. And these changes will just make the analysis more robust, more logical, and frankly, a lot more persuasive to the exact kind of investor it's trying to attract.
A fantastic piece of work.